Welcome to our deep dive into profitability ratios. In the world of business and finance, understanding how well a company turns its resources into profits is crucial. Profitability ratios are key metrics that help investors, managers, and analysts evaluate a company's ability to generate earnings compared to its expenses and other costs. These ratios provide a clear window into the financial health and performance of a business. Throughout this video, we'll explore the main types of profitability ratios, how they're calculated, and what insights they offer. Let's start by understanding why these ratios matter and how they fit into the bigger picture of financial analysis. Profitability ratios are financial metrics used to assess a company's ability to generate profit relative to its revenue, assets, equity, or other financial elements. These ratios are essential for comparing companies within the same industry and for tracking a single company's performance over time. By analyzing profitability ratios, stakeholders can make informed decisions about investments, management strategies, and operational improvement. In essence, these ratios help answer the question, is the business making enough profit from its operations and resources? Gross profit margin is one of the most commonly used profitability ratios. It measures the percentage of revenue that exceeds the cost of goods sold, COGS. In other words, it shows how efficiently a company is producing and selling its products. A higher gross profit margin indicates that a company is retaining more money from each dollar of sales to cover other expenses and profit. This ratio is especially useful for comparing companies in the same industry, as it highlights differences in production efficiency and pricing strategies. Calculate the gross profit margin, subtract the cost of goods sold from total revenue, then divide that number by total revenue. Finally, multiply by 100 to get a percentage. The formula is gross profit margin equals revenue COGS, revenue x 100. This simple calculation provides valuable insight into how much money remains after covering the direct costs of production. Companies with higher gross profit margins are generally more efficient and have more flexibility to manage other expenses. Next, let's look at the operating profit margin. This ratio measures the percentage of revenue left after covering both the cost of goods sold and operating expenses, such as salaries, rent, and utilities. It reflects a company's ability to manage its core business operations efficiently. A higher operating profit margin means the company is better at controlling its operating costs and generating profit from its main activities. This ratio is particularly important for understanding the sustainability of a company's business model. Find the operating profit margin, subtract both the cost of goods sold and operating expenses from total revenue. Then divide the result by total revenue and multiply by 100 to get a percentage. The formula is operating profit margin equals operating profit / revenue x 100. This ratio helps managers and investors see how well a company is controlling its day-to-day expenses and whether its core operations are truly profitable. Net profit margin is perhaps the most comprehensive profitability ratio. It measures the percentage of revenue that remains as profit after all expenses, including operating costs, interest, and taxes, have been deducted. This ratio gives a complete picture of a company's overall profitability. A higher net profit margin means the company is more effective at converting revenue into actual profit, which is a strong indicator of financial health and long-term viability. Calculate the net profit margin, subtract all expenses, including operating costs, interest, and taxes, from total revenue. Then divide the net profit by total revenue and multiply by 100. The formula is net profit margin equals net profit / revenue x 100. This ratio is essential for investors and business owners who want to understand how much of each dollar earned is actually kept as profit after all obligations are met. Return on assets, or ROA, is a profitability ratio that measures how efficiently a company uses its assets to generate profit. It's calculated by dividing net income by total assets. A higher ROA indicates that the company is making good use of its assets to produce earnings. This ratio is especially useful for comparing companies in asset-heavy industries, such as manufacturing or utilities, where effective asset management is critical. Calculate return on assets, simply divide net income by total assets, then multiply by 100 to express it as a percentage. The formula is ROA equals net income / total assets x 100. This ratio helps stakeholders understand how well a company is leveraging its resources to generate profit, and it's a valuable tool for benchmarking against industry peers. Return on equity, or ROE, is another important profitability ratio. It measures how effectively a company uses shareholders' equity to generate profit. ROE is calculated by dividing net income by shareholders' equity. A higher ROE means the company is more efficient at turning equity investments into profits, which is attractive to current and potential investors. Calculate return on equity, divide net income by shareholders' equity and multiply by 100 to get a percentage. The formula is ROE net income / shareholders' equity x 100. This ratio is a favorite among investors because it reveals how well their capital is being used to generate returns. Companies with consistently high ROE are often considered strong investment opportunities. Return on investment, or ROI, is a widely used profitability ratio that measures the gain or loss generated on an investment relative to its cost. ROI is useful for evaluating the efficiency of an investment or comparing the profitability of several investments. A higher ROI means the investment is yielding better returns, making it a critical metric for both businesses and individual investors. Calculate return on investment, subtract the initial cost of the investment from the final value, then divide by the initial cost. Multiply by 100 to get a percentage. The formula is ROI equals final value initial cost x 100. This straightforward calculation helps businesses and investors quickly assess the profitability of their investments. EBITDA margin is a profitability ratio that measures earnings before interest, taxes, depreciation, and amortization as a percentage of total revenue. This ratio provides a clear view of a company's operating profitability by excluding non-operational expenses. It's especially useful for comparing companies with different capital structures or tax situations, as it focuses on core operational performance. Calculate EBITDA margin. Divide EBITDA by total revenue and multiply by 100 to get a percentage. The formula is EBITDA margin equals EBITDA/revenue x 100. This ratio helps analysts and investors understand a company's operating profitability without the influence of financing and accounting decisions. Profitability ratios are essential for understanding a company's financial performance. They help managers identify strengths and weaknesses, guide strategic decisions, and provide investors with confidence in the company's ability to generate returns. By regularly monitoring these ratios, businesses can spot trends, address issues early, and stay competitive in their industry. Profitability ratios are powerful tools for comparing companies within the same industry. By analyzing these ratios, investors and analysts can identify which companies are more efficient, better managed, or more profitable. This comparison helps in making informed investment choices and understanding industry benchmarks. Monitoring profitability ratios over time allows businesses to track their financial progress and measure the impact of strategic decisions. Consistent improvement in these ratios often signals effective management and a strong business model, while declining ratios may indicate underlying problems that need attention. While profitability ratios are valuable, they do have limitations. They rely on accurate financial statements and can be affected by accounting policies or one-time events. Additionally, these ratios don't capture qualitative factors like brand strength or market conditions. It's important to use them alongside other financial and non-financial indicators for a complete analysis. Profitability ratios focus on a company's ability to generate profit, while liquidity ratios measure its ability to meet short-term obligations. Both are important, but they serve different purposes. A company can be profitable but still face liquidity issues, so it's essential to analyze both types of ratios for a full financial picture. Profitability ratios are closely linked to a company's growth potential. High profitability often provides the resources needed for expansion, innovation, and investment in new opportunities. However, rapid growth can sometimes reduce profitability if not managed carefully, so it's important to balance both aspects for long-term success. Profitability ratios can vary widely between industries. For example, technology companies may have higher profit margins than retail businesses due to different cost structures. When analyzing these ratios, always consider industry norms and benchmarks to ensure meaningful comparisons. Economic conditions can significantly affect profitability ratios. During economic downturns, even well-managed companies may see lower margins due to reduced demand or higher costs. Conversely, strong economic growth can boost profitability across many sectors. Always interpret ratios in the context of the broader economy. Strong profitability ratios often reflect effective management. Leaders who control costs, optimize pricing, and drive sales can improve these ratios over time. Monitoring profitability helps managers make informed decisions and adjust strategies to maximize returns. Investors closely watch profitability ratios when evaluating potential investments. High and stable ratios signal a company's ability to generate returns, making it more attractive to shareholders. These ratios also help investors compare opportunities and manage risk in their portfolios. Creditors use profitability ratios to assess a company's ability to repay loans and meet financial obligations. Strong ratios suggest a lower risk of default, which can lead to better borrowing terms. Lenders often require consistent profitability before extending credit. Employees also benefit from strong profitability ratios. Profitable companies are more likely to offer job security, competitive salaries, and opportunities for advancement. Monitoring profitability helps ensure a stable and rewarding work environment. Profitability ratios play a key role in shaping business strategy. By analyzing these metrics, companies can identify which products, services, or markets are most profitable and allocate resources accordingly. This strategic focus helps drive long-term growth and success. In summary, profitability ratios are essential tools for understanding a company's financial health and performance. They help managers, investors, and other stakeholders make informed decisions, compare companies, and track progress over time. By mastering these ratios, you'll be better equipped to analyze businesses and unlock new opportunities for growth and success.